I'm Eric Lipsy, and this is Golf. Today, I'm here with CPA Troy B. Hill. How are you doing today, Troy?
I'm doing good, Eric. Good to see you again, man.
Yeah, good to see you. Thank you very much for coming on. I know a lot of people have questions about what entity they should be in, what should they select when they're starting out in business. I tend to defer to a CPA like yourself, so I'm glad you were able to come on today to provide some sort of clarity for people about choosing the right or the correct entity for the stage that they're in their business. So the first thing I wanted to talk about is sole proprietorship. What could you tell us about the sole proprietorship?
Yeah, so before I jump into the different entity selections,
Sure.
I just want to mention it's probably the most important piece of the entire life of the business is the entity selection. Although after you select a type of entity, you can change it down the road.
Mhm.
It's paramount that you're set up correctly, both from a liability standpoint and a tax standpoint.
Mhm.
My background, I used to be an auditor at the IRS a long time ago. I'm on the good side now, but both as an auditor and in my private practice, it's amazing to me how many businesses out there, even successful ones, are just set up the wrong way,
Mhm.
and are not able to take advantage of certain tax situations, or they're set up the wrong way and they're exposing themselves to a lot of unnecessary liability. So I'm glad we're having this discussion this morning. I just wanted to preface before we get into each different entity type. I
Mhm.
wanted to start by saying how important it was, but also, where this advice is coming from in my background, both at the IRS and in private practice. So let's just jump right in. A sole proprietorship, it's really the way I look at that entity selection. It's really for clients of ours that are kind of doing a side hustle. That's what I call it, or just it's
Yeah.
not a full-fledged business.
Mhm.
Sole proprietorships are good when you're first getting started. Like you want to dip your foot in the water and see, is this going to work? Is it going to be something that I want to pursue? But it really doesn't offer any separate liability protection, and it doesn't offer any tax advantages because it all is getting reported, just like the name says, under the sole proprietor and their social security number. So it's a good starting point,
Uh-huh.
but we have I would say the majority of our clients that are set up as sole proprietorships are doing like multi-level marketing stuff.
Yeah.
Like they're selling Avon, or I'm trying to think of a few of the other big ones. Amway is another one. Sole proprietorship is usually best for somebody that has like another full-time job,
Uh-huh.
and the side business that they're involved in is not going to be generating a lot of revenue, net profit, and they don't have any partners. So sole proprietorship, I'm glad we started there because it's the very basic starting point, but it's really not great for a full-fledged business or somebody that's going to make that their full-time work.
Yeah. And I imagine too, if you're going with the sole proprietorship, you need to have very limited liabilities or none at all if you're going to go that route, because you're on the hook for pretty much anything that happens.
Correct. You're signing personally for everything. If you get sued, they could come after your personal assets. So it's a good starting point to see if like another one is Lyft and Uber drivers. They're set up as sole proprietors.
Mhm.
So yeah, but even we have some that are LLCs, but the basic takeaway should be that sole proprietorship is the very basic starting point. But if you're gonna make it a long-term thing, or if it's going to be a successful business, you want to get out of that entity selection as soon as possible.
Gotcha. Well, thank you. Let's move on to partnerships. Now, this is one I've never known anyone who's actually had one. So maybe you could explain to us what the partnership.
Yeah, there's we'll hit on two different you have 2 and 3 on your list, partnerships and limited partnerships. So I'm going to talk about both of them at the same
Okay,
time.
sounds good. Yeah.
There's a general partnership or a limited partnership. A general partnership, and I'll just use an example. Let's say you and I wanted to form a partnership to help clients in the health industry. So we were going to maybe do personal training, and we were going to help them with their eating habits and different things like that. If we formed a general partnership, we could figure out how much of it you own and how much of it I own. So it could be 75% you, 25% me. the ownership percentage doesn't really matter, but as general partners, we're both on the hook for any liabilities that the business brings in, but we're also splitting the profits. We're on the hook for if we got sued as general partners, they could come after you and I personally. So a general partnership is really when both partners are working in the business and that's kind of their full-time job. A limited partnership would be, let's say that I had the idea that we could create this health business together, and I wanted to raise money. So I would go out to the partners, and let's say that I knew that you were wealthy and that a few of your friends were wealthy, and I just wanted to raise money to get this partnership going. You guys are not necessarily working in the business, and you're not going to be on the hook for any of the liability. I would be the general partner in that situation. You guys would be limited partners, meaning your liability is limited to whatever investment you make in the business, but it's a passive investment. It's really more like we have clients that they do have money to invest. So they get involved in these limited partnerships where they put the money up and they have somebody else that's the expert, using my example in the health industry, that's going to try to make a business out of it. If that business got sued, the limited partners can't lose anything other than their original investment. So it's a good strategy for investors or people that are trying to get involved in businesses or startups that could really take off, but they don't have much to do with the day-to-day operations.
Got it. Now, so it sounds like the general partnership is really just a slight step above the sole proprietorship. Now, what about the liabilities with the partnership? Are they the same as a sole proprietorship? Because they sound pretty similar, but
very, very similar. And the next one that we're going to be talking about is an LLC, but a general partnership, there really is no liability protection for the general partners.
Okay.
They could go after their personal assets. So it's really, we don't have a ton of general partnerships as clients, but I mean, they exist, and there are, the other thing that I'll mention here is, just like with health or anything else, there's specific situations that we're going to be going through that work great for certain clients, and that would not work great for other clients. So for our audience that's listening today, we're kind of giving you high level information, but if you're going to really dive in and start a business and do this, you want to have a specific conversation with a CPA or an attorney so that they can say, well, tell us who's going to be involved. Tell us exactly what industry you're going into. Tell us how much money you're starting this with. Tell us how much debt you're using, because those answers could dictate the correct entity selection.
Makes perfect sense. All right. So you mentioned the LLC. So why don't we take the LLC, go with the LLC next?
Yeah. So an LLC is really, it could go a lot of different directions. When a client sets up an LLC, they've got to decide, is there going to be one owner of the LLC or multiple owners? If you select one owner, that's considered a single member LLC. If you select multiple owners, it's going to be taxed as a partnership, but the limited liability kind of protects certain lawsuits and certain other things. So usually our number one starting point for any new business owner is to set up an LLC first, whether they're going to be doing it on their own or have multiple partners, because it's fluid and you could change the way it's taxed over time. But by having that limited liability up front, you're kind of protecting your personal assets to a certain extent. If you're doing fraudulent things, or if you get sued for malpractice or doing something illegal, the LLC is not going to protect you against that. It's going to protect you from business, like ordinary business transactions, so that they can't get to your personal assets. But LLC is probably the most common entity structure in our office. And that's true whether it's a one owner LLC or a multi-owner LLC, because it offers the most flexibility. Once you set up an LLC, you've got to tell the IRS how you want it taxed.
Yes.
You have the option of being taxed. You could have your LLC taxed on your personal tax return on a Schedule C. You could have it taxed on an S corporation tax return. You could have it taxed on a partnership tax return if there's multiple owners. So as you can see, the LLC it offers the most flexibility and the liability protection that we're looking for. And they're easy to set up and low cost. So I'm not trying to sell you an LLC, but if you are going to start a business, that's where I would definitely recommend that you start. And it's usually 95% of our clients, that's where they start.
Yeah, no, it makes perfect sense because I know for me, once I made the mistake of going to an S corp, which we can talk about next, but I went in too early and without the understanding that I needed to be creating a regular payroll, where I could have just
All
gone
the time.
on to the LLC. It would have just been so much easier. So it just caused a big mess for me.
Yeah, it happens all the time. That's probably the most common mistake that S corporation owners make, is not taking that that W-2 salary. But we'll get into that one. Are we? I think we are on S corporations actually. So let's just jump into that.
All right, sounds good. Yeah.
There's two ways to be taxed as an S corporation. You can set yourself up as an S corporation with the Secretary of State, and then you're automatically taxed as an S corporation with the IRS. So that's option number one. Option number two is to set up the LLC first with the Secretary of State, and then elect with the IRS to have it taxed as an S corporation. And that's usually the route that we go with our clients, because a lot of our clients, by setting up the LLC first, it allows them to get the business going, get it off the ground, not take that payroll, kind of ease into it. And then when they get to the point where it is profitable and they're able to start taking money out of it, that's when we convert it to being taxed as an S corporation. So there are two ways to do that, but our preference in my office, and I'm not an attorney, but we run a tax office. My preference is that those clients start by setting up the LLC. And then when they get to the point where they're profitable and they're taking money out, that's when we'll have it taxed as an S corporation. And really the important thing to keep in mind is what you and I were talking about. As an S corporation, the owners or the officers are required to take a W-2 salary from the business. I'm not going to dig too far into the weeds, but I will explain to our audience that essentially why the IRS wants that happening is on your LLC. If it wasn't taxed as an S corporation, you've got to, on the net profit, you got to pay Social Security, Medicare, federal and state taxes. So 4 different kinds of taxes. If you go the S corporation route, you only have to pay those 4 taxes on your W-2 salary. The remaining profit, you only have to pay federal and state tax on. So you're getting out of Social Security and Medicare on the difference between your salary and the remaining net profit. So it's very valuable, but the IRS knows this. They require that the owners take what they call a reasonable salary. It's not a set amount, but we follow the court cases very closely, and a reasonable salary for a realtor might not be a reasonable salary for a fitness instructor. So you got to look at the industry, you got to look at competitive pay, you got to look at a lot of different things. But the takeaway for our audience should be, if they end up considering going the S corporation route, definitely make sure that they're having the conversation about payroll, because it's required that they're taking a salary, paying payroll tax, filing 941s, that sort of thing. But I would say, if you look at all the business owners in our tax practice, 95% of them start by setting up an LLC. Of those 95%, the ones that become profitable above and beyond $80,000 are then being taxed as S corporations, because there are some downsides to the S corporation. You got to file a separate tax return. You got to do the payroll. So those costs add up. So it's not a good idea right off the bat to be taxed as an S corporation. But yeah, if you look at our book of clients, like I said, 95% of them start out as an LLC. The ones that become profitable above and beyond 80,000, almost 100% of them change to S corporation, because I walk them through the calculation and show them where the tax savings come into play.
Oh, that's great. Now, one of the other things I wanted to ask about is the self-employment tax. I think that you get with the LLC. If you're not collecting the payroll, you're just doing owner's draw. You have what's called the self-employment tax. Maybe you could tell us a little bit about that.
Yeah, it's also known as FICA, but it's basically self-employment taxes, the Social Security and the Medicare taxes that you're paying in. And for anybody that's ever had a W-2 paying job, when you get your pay stub, you see your gross pay might have been $1,000, but they take out Social Security, Medicare, federal and state taxes, and that's how they get to your net pay.
Mhm.
As an LLC or a self-employed person, you got to pay those exact same taxes on the net profit. So let's just use round numbers. Let's say you generate $50,000 of income in your LLC and you have $10,000 of expenses or write-offs. That $40,000 of net profit that's left over, that's what you got to pay Social Security, Medicare, federal and state tax on as an LLC. If you were a W-2 employee, you'd be paying all those taxes on the 40 grand as well.
Right.
As an S corporation, on that 40 grand, let's say we did 20,000 as your W-2 salary and the other 20,000 as a draw, you would only pay those Social Security, Medicare, federal and state taxes on the W-2 salary. The remaining draw, just federal and state taxes.
Yeah. So that's huge. I mean, that's that's a
It's
huge,
about 8%. Yeah. I mean,
yeah.
when we run the numbers, Social Security and Medicare roughly add up to 8%. So somebody that's making above $100,000 could potentially be saving $8,000 in taxes just by changing the way they're structured.
Makes sense. Thank you.
Yeah, definitely.
But, so we touched the LLC and the S Corp there. So let's talk about the C Corp. I know there's probably not a lot of small businesses that end up going to becoming a C Corp, I don't imagine, but
Hardly any small businesses. We have some larger businesses that do it. The benefit of the C Corp, it's a couple of things. You can pay, there's more flexibility for paying the employees benefits out of the C Corporation. And that's whether it's the owner or multiple owners or other employees, like health insurance and things like that. So, but the biggest benefit of the C Corporation is it's completely separate from the owners. It's got its own liabilities, its own bank accounts, its own life. The life of the C Corporation would go on even if the main owner died. The main owner's shares in that C Corporation would either be passed on to his beneficiaries or sold or a lot of different things. But C Corporations are usually more prevalent when there's a lot of unrelated owners. Let's say you and I were going to start a business, but we needed 50 or 60 other investors to get it going with us. C Corp is probably one of the only routes we would think about going in that situation.
Okay. No, that makes sense.
And recently the tax rates for C corporations went down under the last legislation change in 2017. But the downside of a C corporation is the corporation pays tax, and now that's basically 21%. So on the net profit, the corporation pays that 21%. But then if the owners take any of that money out of the business as a dividend, they pay tax on it again. So it's taxed twice.
So it's you're paying taxes twice on the same money. Is that what
Same money, you're paying taxes twice on it if you take it out of the company. If you leave it in the company, you just pay tax on it one time.
Wow.
But there's requirements to take money out too. So yeah, we have very few C corporations. I bet, out of our 1,200 clients, we probably have 3, maybe 4 C corporations, not very many.
And I imagine too, a lot of those C corporations stay really close with their accountants to make sure that they basically don't have all of those profits left at the end if they have to pay it out in bonuses or whatever, maybe, I don't know.
Yeah, well, that's a good point. But there is a lot more red tape too with the C corporation. You got to be doing planning more often. You got to have you got to follow more rules on the Secretary of State side of things with like an annual meeting and minutes and things like that. So it's really not a great entity selection for small business owners or self-employed individuals, which is the majority of our clients.
Yeah, that makes sense. All right. Now with the S Corp, are you required, I believe you are, but are you required to have the board meetings and things like that as well, right?
That's a great question. If you start by filing as an S corporation with the Secretary of State, that option 1 that I was telling you about, you are required to do that. If you start by filing an LLC and then just electing to have it taxed as an S corporation, you're an LLC taxed as an S corporation. So you don't have a lot of those requirements or red tape.
That really sounds like the way to go. Have that LLC and then be registered to you're filing with your taxes with the federal as an S Corp, and then not having that because you don't have the payroll obligation, because that can be tough when you're starting out in business and things, the revenue isn't flowing in the way you want it to, and you still gotta come up, have to pay that payroll. So that,
Yeah, I mean, I would say the typical life of a business is when you're first getting it started, you have more expenses going out the door than income, and you're
yeah.
getting things established, you're working with vendors. So that LLC gives us the flexibility to not have to take a payroll, not have to do the annual meeting, not have to do a lot of things that just red tape that really doesn't change anything. But then when you get to the point where it is established and it's profitable, you can file that election to have it taxed as an S corporation with the IRS in Colorado. So that's why we go that route with the majority of our clients.
Outstanding. Well, I
Yeah.
know you pressed for time, but maybe we can touch on the nonprofit just here for a little bit and talk
Yeah,
about
you bet.
what that is.
A nonprofit, when I first started in business, I couldn't understand why somebody would want to set up a nonprofit. It just, the word nonprofit in general just didn't click with me as an entrepreneur. But we've set up so many of them, and we have so many nonprofits that are just doing great work in the community and have a really good mission. I sit on the board for 2 nonprofits that I help set up actually as well. A nonprofit is really, I mean, it's what it says. The mission or the purpose of the business is not to make a profit and pay that out to the owners. It can be profitable. I think, the biggest nonprofit that people probably know about is the NFL. It's not that it can't be profitable.
Right.
It's those profits have to be plowed back into the mission of the organization. So let's say you and I wanted to set up a nonprofit to help the community with their health needs. I keep going back to that, but let's say our mission was we want to help the community with their health needs. We could take in donations, we could sell t-shirts, we could sell products, we could generate revenue from a lot of different sources. We could also actually be on a salary. So you could take a W-2 and I could take a W-2. But the remaining net profit couldn't be paid out to you and I as owners. It's got to be plowed back into the nonprofit. So the key takeaway here should be, and the reason that is because the nonprofit doesn't pay any taxes on that profit. Whatever's left over, it really is a great deal if you're trying to plow that money back into the organization or the mission. And there's any type of nonprofit you can imagine. I've seen there's for youth sports and animal abuse and child and women abuse and all kinds of different things. As long as that money and the profit that's being generated is going back into the organization, they don't have to pay taxes on it.
Outstanding.
So it is a great tool for those type of, I wouldn't say it's for small business owners or self-employed people. It's just for anybody that wants to do something good for the community. And they're not setting this up to make a profit or take that money out.
Got it. Makes perfect sense. Thank you very much for your time today, Troy. I mean, I really appreciate it. I know you're a very busy man. At least I caught you before tax season starts, right?
Yeah, I love doing things like this, and I appreciate you asking me. And if you get any questions or follow up from any of the audience and they need help with anything, just reach out to me.
Well, actually, I was going to ask if you would be open to sharing a way for them to contact you directly, be it your website, or if they want to reach out to your office, what's the best means for them to do that?
Yeah, definitely. The office phone number is 720-484-6683. Our website is TKV, those are my initials, Troy Kenneth Vigil, so tkvcpa.com. And then my email address is just troy@tkvcpa.com.
Outstanding. Well, thank you very much again, Troy. We really appreciate your time. I know this information is going to be very valuable to our listeners. And yeah, again, thank you very much.
Glad to be here, and thanks for the invite, and hope to see you soon at the gym.
All right, sounds great. Until next time, this is Galt.